Legal disclaimer. The following presentation is strictly intended for educational, informational, and entertainment purposes only. It does not constitute and should not be construed as financial, investment, legal, or tax advice. Foreign exchange trading, commonly known as Forex, involves a substantial risk of loss and is not suitable for every investor. The high degree of leverage often associated with Forex trading can work against you as well as for you. Before deciding to trade foreign exchange, you should carefully consider your investment objectives, level of experience, and risk appetite. There is a tangible possibility that you could sustain a loss of some or all of your initial investment, and therefore, you should not invest money that you cannot afford to lose. You should be aware of all the risks associated with foreign exchange trading, and seek advice from an independent financial advisor if you have any doubts. The platforms, strategies, and historical performance data discussed in this deep dive masterclass are based on past market behaviors and specific platform features as of the time of recording. Past performance is not indicative of future results. The financial markets are dynamic, and regulations within the United States, specifically those enforced by the Commodity Futures Trading Commission, CFTC, and the National Futures Association, NFA, are subject to change. By continuing to watch this content, you acknowledge that you are solely responsible for your own due diligence and financial decisions. Let us look at a statistic that the brokerage industry desperately tries to bury in the fine print. It is a number that defines the career of every single person attempting to enter the global currency markets. That number is 90. In the professional trading world, this is known as the 90-90-90 rule. 90% of new retail traders lose 90% of their starting capital within their first 90 days of active trading. Pause for a moment and let the gravity of that data point sink in. If you walk into a room with 10 aspiring Forex traders today, statistically speaking, only one of them will still be solvent 3 months from now. The vast majority are not just losing a little bit of money. They are experiencing a catastrophic drawdown that wipes out their savings, their confidence, and their potential future in the financial markets. Why does this happen? Most beginners assume the failure rate is entirely due to a lack of strategy. They think they just didn't study enough chart patterns, or they didn't master the Fibonacci retracement levels, or they failed to understand macroeconomic interest rate decisions by the Federal Reserve. While those factors certainly play a role, there is a silent, invisible killer of trading accounts that sits upstream from your strategy. It is the infrastructure you are trading on. It is the platform itself. The reality of the financial markets is that you are not entering a fair fight. You are a retail trader. You are operating in an environment dominated by institutional algorithms, high-frequency trading firms, and massive interbank liquidity providers who have faster data feeds, lower latency, and deeper pockets than you do. When you click buy on your laptop in your home office, that order has to traverse a complex digital landscape before it is executed. If you are using a subpar platform, or worse, an unregulated offshore broker that is betting against you, you are mathematically eliminated before you even place your first trade. This brings us to the specific, high-stakes problem facing traders in the United States. The U.S. Forex market is an island. It is distinct, highly regulated, and frankly confusing for the uninitiated. If you go to Google right now and search for best Forex brokers, you will be bombarded with lists containing names that you, as a U.S. citizen, are legally prohibited from using. The United States government, through the Dodd-Frank Act and regulations enforced by the NFA, has created a protective wall around U.S. traders. This wall prevents you from accessing the high-leverage, 500 to 1 accounts available in Europe or Australia. It prohibits a practice known as hedging, where you hold a buy and sell position on the same currency pair simultaneously. It enforces the FIFO rule, first in, first out, which dictates the order in which you must close multiple trades on the same pair. Most beginners do not understand these nuances. They sign up for a platform they saw advertised on social media, deposit their hard-earned money, and then find themselves locked out of their funds or confused why their trades are closing in an unexpected order. Or even more tragically, they sign up with an offshore, unregulated broker to bypass U.S. rules, only to find that when they make a profit, the broker simply refuses to process the withdrawal. This is not a hypothetical scenario. It is a daily occurrence in the world of online finance. The platform you choose acts as your gateway to the liquidity of the global market. If that gateway is flawed, slow, expensive, or fraudulent, your trading strategy does not matter. You could have the foresight of Warren Buffett and the technical skills of a quant wizard, but if your platform freezes during a high-impact news event like the non-farm payrolls release, Or if the spread, the difference between the buy and sell price, widens excessively just as you enter a trade, you will lose money. The promise of this video series is not to sell you a dream of easy wealth. We are not here to show you rented Lamborghinis or promise that you can quit your job next week. We are here to solve the infrastructure problem. We are here to ensure that you do not become a statistic in the 1990 rule because of a poor platform choice. Over the course of this 10-part masterclass, we are going to conduct a forensic analysis of the available options for U.S. residents. We are stripping away the marketing gloss and the affiliate-driven hype to look at the raw data. We are going to evaluate these platforms based on the metrics that actually impact your bottom line. We will look at execution speed, measured in milliseconds, because in the volatile Forex market, a delay of half a second can mean the difference between a profitable trade and a loss. We are going to analyze the fee structures, looking beyond just the advertised zero commission claims to expose how brokers make money through the spread and swap rates. We will examine the charting software itself, determining which platforms offer the professional-grade technical analysis tools you need to compete with the institutions. We will also discuss the safety of funds, looking strictly at brokers who are registered with the CFTC and are members of the NFA, ensuring that your capital is held in segregated accounts and protected by U.S. law. This is a deep dive. We are going to explain how the FIFO rule impacts your exit strategies on specific platforms. We are going to show you how to read a fee report. We are going to compare the desktop experience versus the mobile app experience because we know that modern trading often happens on the go. We are specifically targeting the beginner demographic, but not by dumbing things down. Instead, we are defining beginner as someone who is smart, motivated, and ready to treat trading as a business, but who needs guidance navigating the specific regulatory and technical landscape of the United States Forex market. By the end of this video, you will have a short list of 5 vetted, compliant, and high-performance trading platforms. You will understand exactly which one aligns with your specific trading style. Whether you are a scalper looking for tight spreads, a swing trader looking for robust research tools, or an algorithmic trader looking for API access, you will have the confidence to deposit your initial capital knowing that your money is safe, your execution is fair, and your tools are sharp. We are clearing the fog of war so that you can focus on what really matters. Reading the market and executing your edge. This is the foundation. Everything else you learn about trading rests on this decision. Let us begin the analysis. To understand which platform deserves your capital, we must first establish the lens through which we are viewing the entire landscape. We are not evaluating these platforms based on their marketing budgets, the sleekness of their Super Bowl commercials, or the celebrity endorsements they might have secured. Those are vanity metrics designed to distract you. Instead, we are applying a forensic vetting matrix that isolates the specific variables that determine longevity in this game. When you are a beginner, your primary goal is not maximizing profit. Your primary goal is survival. You are trying to stay in the game long enough to learn the skill. Therefore, the very first filter in our matrix is what we call the regulatory shield. Imagine for a moment you are walking down a dark alley in a city you do not know. In one hand, you are holding a briefcase containing your life savings. A stranger approaches you and offers to hold that briefcase for you while you go into a store. They promise they will give it back, and they even promise to add more money to it while you are gone. Would you hand it over? Of course not. Yet, thousands of aspiring U.S. traders do exactly this every month by signing up with offshore, unregulated brokers. They see an ad on Instagram promising 1,000 to 1 leverage or no KYC, know your customer requirements, and they send their money to a bank account in a jurisdiction where U.S. laws have no power. The moment that money leaves the U.S. banking system and enters an unregulated entity, it is technically no longer yours. It belongs to the broker. If that broker decides to fold, or if they simply decide that your profitable trading style is abusive to their system, they can freeze your account. There is no number you can call. There is no office you can visit. The money is simply gone. This is why, for this list, we are strictly, uncompromisingly looking at platforms regulated by the Commodity Futures Trading Commission, CFTC, and the National Futures Association, NFA. When a broker is NFA regulated, they are subject to rigorous capital requirements. They must hold millions of dollars in liquidity just to operate. More importantly, they must keep your money in segregated accounts. This means your trading funds are not mixed with the company's operational funds. If the broker goes bankrupt, your money cannot be used to pay their debts. This is the regulatory shield. It is boring, it is unsexy, and it is the only thing standing between you and total systemic risk. Every platform we discuss today passes this test. Now let's move to the first platform on our list. This platform is often considered the gold standard for beginners in the United States, not because it has the flashiest interface, but because it solves the single biggest mathematical problem new traders face: position sizing. Platform number 1 is OANDA. To understand why OANDA is the first recommendation for a beginner, we have to do a deep dive into the math of a trade. This is where most new traders blow up their accounts. In the traditional Forex world, currencies are traded in lots. A standard lot is 100,000 units of currency. If you are trading the euro to US dollar pair, a 1 pip movement, the smallest standard price move, on a standard lot is worth roughly $10. Now, imagine you are a beginner starting with a modest account of $500. If you open a trade with a standard lot, and the market moves just 50 pips against you, which can happen in a matter of minutes during a news event, you have lost $500. Your account is zero. You are done. Even if you trade mini lots, 10,000 units, $1 per pip, or micro lots, 1,000 units, 10 cents per pip, you are still constrained by these rigid block sizes. If you want to risk exactly 1% of your $500 account on a specific trade setup, the math often doesn't work with micro lots. You might have to risk 3% or 0.5%, forcing you to either take too much risk or trade too small to care. OANDA changes this entire dynamic with a proprietary feature that is almost unique in the US market. They do not force you to trade in lots. They allow you to trade in units. You can trade literally 1 unit of currency. This means you could open a position where a 1 pip movement is worth a fraction of a penny. Why does this matter? Let's look at a case study. Meet Alex, a hypothetical beginner trader based in Ohio. Alex has saved $1,000 to learn trading. He has read that he should never risk more than 2% of his account on a single trade. That means his maximum loss per trade should be $20. Alex spots a setup on the pound sterling to US dollar pair. His technical analysis tells him that his stop loss, the point where he admits he is wrong and exits, needs to be 60 pips away from his entry price. If Alex is using a broker that only allows micro lots, the math is brutal. 1 micro lot is roughly 10 cents per pip. A 60 pip stop loss would cost him $6. That is 0.6% risk. If he doubles it to 2 micro lots, he is risking $12, 1.2%. If he goes to 3 micro lots, he is risking $18, 1.8%. If he goes to 4, he is risking $24, 2.4%. He cannot hit his 2% target exactly. He has to be imprecise. Now look at Alex on OANDA. Because he can trade exact units, he can calculate exactly how many units will result in a $20 loss if the price moves 60 pips. He can tailor his position size down to the single dollar. This precision allows Alex to scale into trades, to test strategies with virtually zero risk, and to survive losing streaks that would wipe out a trader forced to use larger lot sizes. This feature alone makes OANDA the superior choice for anyone with an account balance under $5,000. It removes the pressure. It turns trading into a game of percentages rather than a game of dollar amounts, which is the psychological shift every professional eventually makes. Beyond the math of units, we must discuss the engine you will be using to look at charts. Most brokers provide their own proprietary software. Some of it is decent. Most of it is clunky, reminiscent of Windows 95. OANDA, however, has fully integrated with TradingView. If you are not familiar, TradingView is the industry standard for charting. It is the software you see used by almost every financial YouTuber and analyst. It is clean, it is cloud-based, and it has thousands of custom indicators. With OANDA, you can connect your brokerage account directly to the TradingView interface. This means you can do your analysis on the world's best charts and execute the trade without ever leaving the screen. You don't have to analyze on one tab, and then frantically alt-tab to your broker to click buy. It is seamless. For a beginner, this reduces cognitive load. You are not fighting the software, you are just analyzing the price. You can set alerts on your phone through the TradingView app, and when an alert triggers, you can execute the trade immediately through the integration. This ecosystem creates a professional-grade workflow even for a part-time trader. However, no platform is perfect. We must look at the other side of the coin. While OANDA excels in flexibility and software integration, there is a cost. OANDA operates largely on a spread-only model for its standard accounts. This means they do not charge a commission per trade, but they mark up the spread, the difference between the buy and sell price. For major pairs like the euro to US dollar, this spread is usually competitive. But if you decide to trade exotic pairs or during times of low liquidity, that spread can widen. For a scalper, someone who tries to snatch 2 or 3 pips of profit in seconds, spreads are the enemy. If the spread is 1.5 pips, you start every trade 1.5 pips in the hole. To make 3 pips of profit, the market has to move 4.5 pips in your favor. That is a significant hurdle. ONDA is a market maker. This means they are often the counterparty to your trade. While they are regulated and trustworthy, some advanced traders prefer a model where the broker acts purely as an agent, passing orders directly to the banks. This leads us to a critical question. ONDA is the king of flexibility in small accounts. It is the safe harbor for the learner. But what if you are ready to graduate? What if you have a slightly larger capital base and your strategy relies on raw speed and the tightest possible spreads? What if you want a platform that doesn't just simulate the market, but connects you directly to the raw data feeds used by institutional desks? There is a platform that dominates this specific sector of the US market. It is a powerhouse that boasts high-volume capability and a different pricing structure that might actually save you money once your volume increases. It caters to the trader who has moved past the survival phase and is entering the performance phase. But be warned, its interface is not as forgiving, and its tools assume you already know what you are doing. We are going to break down this high-performance contender in the next part of our deep dive. The platform that answers the call for raw performance and institutional-grade execution is Interactive Brokers, often abbreviated as IBKR. If OANDA is the friendly neighborhood bank that helps you open your first savings account, Interactive Brokers is the chaotic, high-energy trading floor on Wall Street. It is cold, efficient, and unapologetically complex. It is not designed to hold your hand. It is designed to execute your orders with ruthless efficiency and minimal cost. For years, Interactive Brokers has been the secret weapon of professional retail traders and small hedge funds. The reason boils down to a single powerful concept that every beginner must grasp to survive in the long run: cost of carry. In the previous section, we discussed the spread-only model, where the broker bakes their fee into the price you see. You don't see a commission line item on your statement, so you feel like the trade was free. But it wasn't. You paid it in the spread. Interactive Brokers operates on a completely different philosophy, often utilizing a commission-based structure for their spot Forex operations. Let's break down the mathematics of why this matters, and we will use a case study of scale to illustrate the point. Imagine a trader named Sarah. Sarah has graduated from the survival phase. She has a $10,000 account and she trades frequently, maybe 5 times a day. She trades the euro to US dollar pair. On a standard zero commission broker, the spread for euro to US dollar might be averaged at 1.2 pips. If Sarah trades a standard lot, which is 100,000 units, that 1.2 pip spread costs her roughly $12 simply to open the position. She starts every trade down $12. Over 5 trades a day, that is $60 in transaction costs. Over a month of 20 trading days, that is $1,200 in fees. That is 12% of her entire account balance paid to the broker in 1 month, just for the privilege of clicking buttons. Now let's look at Sarah's operation on Interactive Brokers. IBKR connects directly to interbank liquidity providers. Because they are not trying to mark up the spread to make their money, the spread you see is the raw market spread. On euro to US dollar, this can be as low as 0.1 or 0.2 pips. Sometimes, in highly liquid moments, it is literally zero. However, IBKR charges a commission. Let's estimate the commission at roughly $2 to $3 per lot per side. This varies based on monthly volume and tier structure, but we will use standard estimates for this example. So, Sarah opens that same standard lot. The spread is 0.2 pips, which costs her $2. The commission is roughly $2.50. Her total cost to enter the trade is $4.50. Compare that to the $12 she paid at the other broker. She has saved $7.50 per trade. Multiply that by her 5 trades a day, and she saves $37.50 daily. Over the month, she saves $750. That is $750 of her profit that stays in her pocket rather than going to the broker. In a game of thin margins, that 7.5% difference in retained capital is often the mathematical difference between a profitable year and a losing one. This is why professionals migrate to commission-based structures as soon as their volume justifies it. However, there is a catch. And for beginners, it is a massive one. Interactive Brokers is not user-friendly. When you log into their flagship desktop software, the Trader Workstation, TWS, you will not see a cute, simplified interface with big green buy and red sell buttons. You will see a cockpit. You will be bombarded with data. A mosaic of order books, level 2 market data, option chains, news feeds, and algorithmic order entry tools. It looks like a spreadsheet from the 1990s exploded onto your screen. For a complete novice, this is terrifying. The learning curve for the software alone is steep. You have to configure data subscriptions, understand order routing settings, and navigate a menu system that feels like it was designed by engineers for engineers. There are no gamified achievements here. There is no confetti when you place a trade. It is a utilitarian tool built for war. If you click the wrong button in TWS, you might accidentally route an order incorrectly or misunderstand the leverage parameters because the platform assumes you know what you are doing. It does not ask, "Are you sure?" Simply executes. Furthermore, Interactive Brokers demands a higher level of capital adequacy. While they have removed their strict account minimums for opening an account, the reality of their fee structure benefits those with larger balances. If you are trading tiny microlots, the minimum commission fees might actually work out to be more expensive than the spread-only model of OANDA. There is a crossover point, usually around the $5,000 to $10,000 account size, where the math flips in favor of the commission model. If you are trading with $500, the minimum commission bite will eat you alive. But there is another massive advantage to IBKR that we must discuss: safety and breadth. Interactive Brokers is a publicly traded company listed on the NASDAQ. They hold billions in equity capital. In the shady world of Forex, where brokers pop up and disappear overnight, IBKR is a fortress. They are regulated not just by the US authorities, CFTC/NFA, but by practically every major financial regulator on the planet, from the UK's FCA to Australia's ASIC. When you deposit money here, you are depositing it into a global financial institution, not a startup. Additionally, IBKR is not just for Forex. This is a crucial lifestyle consideration for a beginner. Most traders eventually branch out. You might want to buy some Apple stock for a long-term hold, or hedge your currency exposure with gold futures, or trade options on the S&P 500. With most Forex-specific brokers, you are stuck in the currency silo. If you want to trade stocks, you have to open a different account with a different broker. With Interactive Brokers, you have a universal account. You can trade Forex, stocks, options, futures, bonds, and ETFs all from the same screen, using the same capital pool. This creates incredibly powerful opportunities. Imagine the US dollar is crashing. You can short the US dollar to Japanese yen currency pair and simultaneously buy gold futures to double down on the thesis, all within seconds, all in one interface. So, the verdict on platform number 2? Interactive Brokers is the destination. It is where you want to end up. It offers the lowest costs for volume traders, the deepest liquidity, and the highest safety profile. But it demands respect. It demands that you educate yourself on how to operate the machinery. If you try to fly this fighter jet without reading the manual, you will crash. This leaves a massive gap in the market. We have OANDA for the cautious, small account beginner who needs flexibility. We have Interactive Brokers for the aspiring professional who wants raw power and low costs. But what about the chartist? What about the trader who identifies as a visual learner? What about the person who wants the power of professional analysis tools, better than OANDA's defaults, but finds the Interactive Brokers interface too ugly and clunky to use? There is a platform that exists exactly in this sweet spot. It was built by a company that revolutionized how retail traders view market data. It is famous for a specific platform that is widely considered to be the most powerful technical analysis software ever created for retail traders. It is so good that when a major brokerage acquired the company, they kept the software exactly as it was because the user base revolted at the thought of losing it. This platform turns your screen into a canvas, allowing you to visualize the market in 3D, to code your own indicators without being a computer scientist, and to access an educational library that is arguably the best in the United States. If you are the type of person who loves drawing on charts, analyzing patterns, and backtesting strategies visually, the next platform on our list is the only choice you should consider. Let's introduce the Titan of Technicals. Platform number 3 is the undisputed king of visualization, Thinkorswim by Charles Schwab. If you ask a room full of veteran traders in the United States what software they learned on, more than half of them will say TOS or Thinkorswim. For over a decade, This platform was the crown jewel of TD Ameritrade. When Charles Schwab acquired TD Ameritrade in a massive brokerage consolidation, there was genuine panic in the trading community. Traders were terrified that Schwab would kill the platform or merge it into their more traditional, conservative interface. But Schwab did the smart thing. They realized that thinkorswim isn't just a platform. It is a cult. They kept it, integrated it, and now it stands as the premier destination for the visual scientist of the financial markets. Why do we call it the Titan of technicals? Because thinkorswim treats the chart not just as a display of price history, but as a programmable, malleable workspace. Most beginner platforms give you the basics: a line chart, maybe some candlesticks, and a moving average. Thinkorswim gives you a laboratory. Let's illustrate this with a specific feature that is arguably the most valuable educational tool in existence for a beginner, yet it is totally absent from most other platforms. It is a feature called On Demand. Imagine this scenario. You are a new trader named David. You have read about the financial crisis of 2008. You have read about the flash crash of 2010. You have read about the day the Swiss National Bank unpegged the franc in 2015, causing one of the most violent market moves in history. You want to know how your strategy would have performed on those specific days. On a normal platform, you can scroll back in time and look at the static chart. You can see the big red candle. You can say, "Oh, I would have sold there." But that is hindsight bias. It is easy to predict the past when you can see the future on the right side of the screen. With thinkorswim's On Demand, David can literally turn his platform into a time machine. He can click a button, type in January 15, 2015, and the entire platform, the data feeds, the news ticker, the level 2 quotes, reverts to that exact moment in history. The right side of the chart disappears. The market begins to tick second by second, exactly as it did on that day. David can place trades in this simulation, experience the volatility, feel the panic of the price whipsawing, and see if his stop-loss holds, all using historical data replay. He is not backtesting a spreadsheet. He is backtesting his nervous system. He can relive 10 years of market history in a few weekends. For a beginner, this accelerates the learning curve by a factor of 10. You are gaining experience from events that happened before you even opened your account. Beyond the time machine, we must discuss the language of the platform, ThinkScript. In the previous section, we mentioned that interactive brokers is great for algorithmic traders, but it usually requires knowledge of Python or C++ and a complex API connection. Thinkorswim takes a different approach. They built a proprietary scripting language designed for traders, not software engineers. Let's look at a practical application. Suppose you have a specific idea. I want to buy the euro to US dollar, but only when the price is above the 200-day moving average and the relative strength index, RSI, is below 30, and the time is between 8 a.m. and 11 a.m. New York time. On most platforms, you have to stare at the screen all day waiting for those 3 stars to align. You become a prisoner to your monitor. On thinkorswim, you can click on the Scan tab. You don't need to hire a coder. You can use their condition wizard to drag and drop these logic blocks together. Within 5 minutes, you have built a custom scanner that monitors thousands of currency pairs and stocks simultaneously. When those specific conditions are met, the platform sends a text message to your phone. You have effectively cloned yourself. You have automated the hunting phase of trading, so you can focus on the execution phase. Furthermore, the Flex Grid feature allows you to customize your screen real estate in a way that feels like you are in a movie. You can have a 5-minute chart of the US dollar to Japanese yen next to a daily chart of oil futures, sitting on top of a live news feed filtered only for Federal Reserve keywords. You can link these windows so that if you click on a currency pair in your watch list, every single chart on your screen instantly updates to that pair. This reduces the friction of analysis. When the market is moving fast, you don't have time to reconfigure your windows. Thinkorswim moves at the speed of your thought process. However, we must address the elephant in the room: complexity overload. If OANDA is a bicycle and interactive brokers is a fighter jet, thinkorswim is the space shuttle. It has thousands of buttons, knobs, and switches. When you first launch the software, it is overwhelmingly likely that you will feel stupid. You will stare at the screen and have no idea how to simply place a buy order. The default settings are often cluttered with too much information. This is where the Schwab ecosystem comes into play to save you. Since the acquisition, Charles Schwab has doubled down on education. We are not talking about a few PDF articles on what is a pip. We are talking about a live broadcasting media network. Through the platform, You can access a live stream of professional analysts who are trading the market in real time using the thinkorswim software. You can watch them navigate the menus. You can see how they set up their charts. It is a watch and learn environment that is unparalleled in the industry. They have entire courses dedicated just to mastering the software. If you are willing to study, the resources are there. But what about the cost? This is where thinkorswim sits comfortably in the middle. They are not a discount, raw spread broker like the high-volume tiers of interactive brokers, nor are they a dedicated Forex specialist like OANDA. Their spreads are standard. You will typically see slightly wider spreads on thinkorswim than you might on a pure-play Forex broker because Schwab is a multi-asset behemoth. They make their money on the sheer volume of retail clients. For a scalper looking to capture 1 pip, thinkorswim might be too expensive due to the spread. But for a swing trader, someone holding positions for days or weeks, the spread is negligible compared to the value of the tools you are getting. There is also a psychological comfort factor here. Charles Schwab is a bank. It is one of the largest financial institutions on the planet. Your money is not sitting in a segregated account at a niche firm. It is sitting inside a fortress of American finance. For many beginners, specifically those with significant savings who are apprehensive about the reputation of the Forex industry, this brand trust is the deciding factor. You know Schwab will answer the phone. You know they aren't going to disappear to an island in the Caribbean. So we have covered the flexible specialist, OANDA, the high-performance engine interactive brokers, and the visual powerhouse thinkorswim. You might think we have covered every base, but we haven't. There is a massive segment of the global trading population that refuses to use any of these proprietary platforms. They don't want to learn thinkorswim's interface, and they certainly don't want to deal with interactive brokers' complexity. They want to use the universal language of trading software. They want to use the platform that allows them to buy trading robots, expert advisors, from a marketplace and plug them in instantly. They want the software that 90% of the rest of the world uses, but which is surprisingly hard to find in a regulated US environment. If you are a trader who wants to follow international mentors, download custom indicators from forums, or run automated bot strategies that you bought online, you cannot use thinkorswim. You cannot use the standard interactive brokers app. You need a specific bridge to the world of MetaTrader. And there are only 2 serious contenders left in the US market that do this well. The next platform on our list is not just a broker. It is a market access provider that dominates the global landscape and has fought tooth and nail to keep its doors open to US clients, offering a specific tool that none of the previous 3 can match. This is the platform for the global citizen, trapped behind US regulations. Let's reveal the gateway. Platform number 4 is the behemoth, the standard bearer, and the bridge to the global trading community, Forex.com. To understand why this platform is critical for a specific type of trader, we have to step away from the software for a moment and talk about platform risk and skill portability. If you spend 5 years mastering thinkorswim, learning every hotkey, every proprietary script function, and every menu nuance, you are effectively married to Charles Schwab. If regulations change, or if you move to a different country, or if the broker changes its fee structure in a way you dislike, you are trapped. Your skills are not portable. You cannot take your ThinkScript code and plug it into a broker in London or Singapore. You are living in a walled garden. Forex.com is the antithesis of the walled garden. While they do have a decent proprietary mobile app and web platform, their true power, and the reason they are the largest MetaTrader broker in the United States, lies in their embrace of the universal language of trading MetaTrader 4 and MetaTrader 5. For the uninitiated, MetaTrader, specifically MT4, looks ancient. It looks like it was designed for Windows 98. It is gray, blocky, and visually unappealing compared to the sleek curves of modern apps. But do not let the aesthetics fool you. This ugliness is a feature, not a bug. It is the stripped-down raw chassis of a race car. Because it is the global standard, it has an ecosystem that no other platform can touch. Imagine you are browsing a forum based in Tokyo, and you find a Japanese trader who has developed an incredible indicator that detects institutional order flow. You want to use it. If you are on thinkorswim, you can't. You would have to try to reverse engineer the code and rewrite it. If you are on Forex.com using MT4, you simply download the file, drag it into your folder, and restart the platform. It works instantly. You have just imported intellectual property from across the ocean into your home office in Chicago. This is the global citizen aspect. Forex.com allows you to tap into the collective intelligence of millions of traders worldwide. If you want to run an expert advisor, a robotic trading algorithm that trades while you sleep, you are likely going to find it written in MQL4, the language of MetaTrader. Forex.com provides the robust, regulated US infrastructure to run these global strategies. They offer free virtual private server VPS, hosting for active traders, which means your robot can live in the cloud, connected to the market 24/7, even if your laptop runs out of battery or your home internet cuts out during a storm. But remember the hook from the previous section? We mentioned a specific tool that none of the previous 3 platforms, OANDA, Interactive Brokers, or Thinkorswim, can match. That tool is not MetaTrader itself, since OANDA also offers it. The unique differentiator for Forex.com is a proprietary engine called Performance Analytics. Most beginners keep a trading journal. They write down, "I bought Eurodollar because the RSI was low." That is a static record. It is dead data. Forex.com has integrated a behavioral science engine, originally developed by a company called Chasing Returns, that acts as a digital psychologist. It does not just list your trades, it psychoanalyzes them. Let's run a case study to see the power of this tool. Meet Marcus. Marcus is a break-even trader. He makes money some months and loses it in others. He feels stuck. He logs into his Forex.com Performance Analytics dashboard. The engine has crunched the data of his last 500 trades. It presents him with a psychological edge report. The data reveals a pattern Marcus was completely unaware of. The system flags that Marcus has a 70% win rate on trades placed between 8 a.m. and 11 a.m., but a 20% win rate on trades placed after 2 p.m. It tells him explicitly, "You are giving back your morning profits by overtrading in the afternoon." But it goes deeper. It analyzes his holding time. The system shows him that his most profitable trades are held for an average of 4 hours, but his losing trades are held for an average of 24 hours. This is a classic cognitive bias known as the disposition effect, holding losers hoping they will come back, while cutting winners too early. The tool visualizes this data for him. It practically screams, "Marcus, stop holding your losers overnight." Thinkorswim can show you a chart of your balance. Interactive Brokers can show you a statement of your fees. But Forex.com's Performance Analytics tells you who you are. For a beginner who is fighting their own emotions more than the market, this feedback loop is invaluable. It turns the nebulous concept of discipline into hard data points that you can fix. Now, we must address the cost and execution structure, because Forex.com offers a tiered system that can be confusing. For the standard beginner, they operate as a market maker with a standard account. The spreads are competitive, generally floating around 1.0 to 1.4 pips on the euro to US dollar. It's solid, reliable, and transparent. However, Forex.com has a secret weapon for the aspiring professional: the DMA, Direct Market Access, account. This is their answer to Interactive Brokers. If you deposit a certain amount, typically $25,000 recommended, though thresholds vary, you can access the raw spread. We are talking about spreads that can drop to 0.0 or 0.1 pips. In exchange, you pay a commission. Why would you choose Forex.com's DMA over Interactive Brokers? The answer is the interface. If you are an algorithmic trader who needs the raw pricing of the interbank market, but you must use MetaTrader 5 because your entire strategy is coded in MQL5, Interactive Brokers cannot help you. They don't support MT5. Forex.com fills this massive void. They give you the institutional pricing model, wrapped in the retail-friendly MetaTrader shell. Furthermore, as part of the StoneX Group, a Fortune 100 company, Forex.com has deep liquidity pools. This matters during black swan events. When the market crashes, liquidity dries up. Small brokers freeze. You try to close a trade and the button just spins. Because StoneX is a massive institutional player, Forex.com often maintains liquidity when others fail. They are the too big to fail option in the US retail Forex space. So where does this leave us? If you are a small account holder who needs position sizing flexibility, Oanda. If you are a volume trader wanting the absolute lowest cost and multi-asset access, Interactive Brokers. If you are a visual learner who wants the best charting lab, Thinkorswim. If you are a global citizen who wants to use bots, MetaTrader, and needs a digital psychologist to fix your bad habits, Forex.com. Seems like a complete list. We have covered every base. But we haven't. There is a final category of trader. This trader is looking for simplicity, but not at the expense of quality. They are looking for a specific type of low-friction experience. They are intimidated by the complexity of thinkorswim. They find interactive brokers too hostile, and they find the MetaTrader interface too ugly and dated. They want a modern web-based platform that is sleek, incredibly fast, and comes from a broker that is arguably the most prestigious name in the entire global spread betting and CFD industry. A giant that recently reawakened in the US market with a singular focus on Forex. This final platform is the sleeping giant. They don't shout the loudest in marketing, but their technology is arguably the cleanest. They offer a charting package that rivals TradingView but is built in, and they have a unique no-dealer desk execution style on their primary offering that sits right between the market makers and the ECNs. If you want a premium, bespoke feel without the headache of 1990s software, this is the one. Let's uncover the final contender. Platform number 5 is the reawakened giant, TasteFX, formerly IGUS. If you have been trading for less than 5 years, the name IG might just sound like another pair of letters. But to the old guard of the financial world, IG Group is royalty. Founded in London in 1974, they literally invented the concept of financial spread betting. They are a FTSE 250 company with a market cap in the billions. For decades, they dominated Europe and Australia. Then they made a quiet entry into the US market. And recently, they underwent a massive metamorphosis, rebranding their US Forex arm to TasteFX. Why is this the sleeping giant? Because for years, US traders were forced to choose between clunky, ugly software, MetaTrader, or complex professional workstations, interactive brokers. There was no Apple of trading, no platform that was beautiful, intuitive, and powerful all at once. TasteFX fills this void with a vengeance. Let's talk about the low-friction experience. Imagine you are a graphic designer or a software engineer. You appreciate clean UI. You hate installing .exe files from 2005. You want to log in from any browser, Chrome, Safari, Edge, and have your charts load instantly, looking crisp and modern. This is TasteFX's superpower. Their HTML5 web platform is arguably the smoothest in the industry. It doesn't feel like finance software. It feels like a modern tech product. But do not mistake clean for simple. Under the hood, TasteFX is running an execution engine that challenges the traditional market maker stigma. While they are technically a dealer, meaning they are the counterparty to your trade, they operate with such massive global scale that they can offer spreads that rival the raw ECNs. We are talking about a standard spread on euro to US dollar that frequently hovers around 0.8 pips. Let's pause and do the math on that. On a standard zero commission broker, you are usually paying 1.2 to 1.4 pips. On TasteFX, paying 0.8 pips means you are saving roughly $4 to $6 per standard lot purely on the spread. Over 100 trades, that is $500 in savings. And unlike the raw ECN accounts at other brokers, you are not paying a separate commission on top of this. It is an all-inclusive price. For a discretionary trader, someone who trades manually based on price action, this is often the mathematical sweet spot between cost and simplicity. There is another feature here that is almost unheard of for beginner accounts in the US: volume-based cash rebates. Usually, to get cash back on your trading volume, you need to be a massive institutional whale trading hundreds of millions of dollars a month. TasteFX has democratized this. They have a tiered rebate program where, if your volume hits a certain threshold, which is surprisingly reachable for active retail traders, they actually pay you back a portion of the spread. Imagine this scenario. You are an active day trader. You trade 10 lots a day. At the end of the month, instead of just seeing your profits or losses, you see a credit hit your account. It's a rebate check. In a game where the house usually takes everything, TasteFX is one of the few venues where the house gives a little bit back. This aligns their incentives with yours. They want you to trade more, so they want you to survive longer. However, we must address the no dealer desk nuance referenced earlier. TasteFX is unique because while they are a dealer, they do not act like a bucket shop. A bucket shop holds your order and bets against you, hoping you lose. TasteFX, backed by the massive liquidity of IG Group, hedges its exposure in the underlying market. They are indifferent to your win or loss. They just want the volume. This subtle distinction creates a trade execution environment that feels incredibly fast. No requotes, no order rejections during news events. Usually, just instant fills. So, we have completed our roster of the top 5. OANDA, the flexible, unit-based haven for small accounts. Interactive brokers, the high-performance, low-cost engine for professionals. Thinkorswim, the visual laboratory for technical analysts. Forex.com, the gateway to MetaTrader, global tools, and performance psychology. Tastifx, the modern low-friction, tight-spread choice for the digital generation. You now have the list. You have the what. Most videos would end here. They would say, link in description, good luck, and leave you to the wolves. But this is a deep dive masterclass. Knowing the names of the platforms is only 10% of the battle. The other 90% is the onboarding and verification minefield. Here is a terrifying reality. Every single day, hundreds of US applicants get soft banned from these platforms before they even place a trade. They fill out the application form, they answer a specific question about their net worth or trading experience incorrectly, and the compliance algorithm instantly flags them. They get a rejection email stating, "We cannot open an account for you at this time." Once you are flagged, you are often blacklisted internally for months. You cannot just try again with different answers. That is considered fraud. You have effectively locked yourself out of the market because you didn't understand the legal language of the application. Furthermore, even if you get approved, there is the funding trap. You deposit money using the wrong method, maybe a credit card or a third-party transfer, and your funds get frozen for 60 days due to anti-money laundering, AML, laws. You see a perfect trade setup, but your money is in administrative purgatory. In the next part of this series, we are going to walk you through the application gauntlet. I am going to show you exactly what the regulators are asking, why they are asking it, and how to navigate the KYC, know your customer, process so that you get approved instantly, your funds clear immediately, and you don't accidentally trigger a federal compliance audit on your first day. We are moving from selection to action. Do not fill out a single form until you watch the next video. Welcome to the application gauntlet. This is the phase where the dream of trading dies for thousands of Americans before they even download a chart. You might think opening a brokerage account is like signing up for Netflix, just an email, a password, and a credit card. You would be wrong. Opening a Forex account in the United States is more akin to applying for a mortgage or a security clearance. The institutions you are dealing with, OANDAIG, Schwab, are under immense pressure from the federal government to prevent money laundering, terrorism financing, and the exploitation of vulnerable citizens. Because of this pressure, they have automated their rejection systems. They use algorithms to scan your application in milliseconds. If you trigger a specific logic gate, you are instantly classified as unsuitable. The screen goes gray, and you receive a generic message saying they cannot offer you services. There is no appeal process. You cannot call customer support and say, "Oops, I clicked the wrong button." Once that data is submitted, it is a permanent legal record. To survive this, you must understand the language of the compliance black box. Let's analyze the first and most lethal trap, the financial background section. You will be asked two very specific questions: total net worth and liquid net worth. Most beginners rush through this. They think the broker is just being nosy or trying to upsell them. In reality, the broker is calculating your risk capital. Meet case study Honest Henry. Henry is a college student. He has $2,000 in his checking account, a car worth $5,000, and a laptop. He wants to trade with $500. When the form asks for liquid net worth, he thinks, well, I have $2,000 in the bank. He selects the bracket 0 to $19,999. Then the form asks for annual income. He works part-time, so he selects less than $25,000. Finally, the form asks for source of funds. He selects savings. Henry hits submit. Instant rejection. Why? Because legally, a person with less than $25,000 in annual income and low liquid assets is considered vulnerable. The regulators, specifically the NFA, have determined that Henry cannot afford to lose that $500. If the broker allows Henry to trade and he loses, Henry could technically sue the broker for predatory practices, claiming they allowed an unsuitable client to access high-risk leverage. The broker's algorithm is programmed to protect the broker, not Henry. It auto-rejects him to avoid the liability. Now look at case study B, Educated Eddie. Eddie is in a similar financial situation, but he understands the definitions. He realizes that liquid net worth isn't just cash. It includes stocks, bonds, and arguably crypto assets that can be quickly converted to cash. He realizes that annual income might include household contributions if he is married or supported. He calculates his financial standing not based on what is in his pocket today, but on his total accessible liquidity. Eddie falls into a slightly higher bracket. He passes the filter. The point here is not to fabricate numbers, that is fraud and it is illegal. The point is to understand that if you strictly minimize your financial status because you are being overly modest or narrow in your definitions, you are mathematically eliminating yourself from the market. The system requires you to have risk capital, money that, if lost, will not change your standard of living. If your application data suggests that losing $500 means you can't pay rent, the door slams shut. The second trap is the trading experience paradox. This is the catch-22 of the financial world. The application will ask, how many years have you traded spot Forex? And how many trades have you placed in the last 12 months? If you answer 0 years and 0 trades, the compliance logic faces a dilemma. You are asking for access to a complex, leveraged derivative product, but you have just admitted you have 0 experience. In many jurisdictions, the broker is legally required to block you or force you to take a competency quiz. If you fail the quiz, you are banned. However, what counts as experience? Most beginners assume this means real money live trading. But does it? If you have spent the last 6 months on a simulator paper trading, executing hundreds of trades, managing risk, and learning the software, do you have 0 experience? Technically, no. You have simulated experience. Many brokers view educated novices differently than total blank slates. If you select 0 years, you are signaling that you don't even know what a bid/ask spread is. If you have actually studied, taken courses, and practiced on demos, you are not a 0-year candidate in terms of knowledge. You must accurately reflect your level of competence. If you portray yourself as completely clueless, the broker, acting as a responsible fiduciary, has a duty to protect you from yourself by denying the account. Once you pass the application, you enter the funding minefield. This is where your money gets taken hostage. The #1 cause of frozen funds in the USA is the third-party transfer rule. Imagine you want to fund your new OANDA account with $5,000. You don't have the money in your personal checking account, but you have it in your LLC's business account, or your spouse has it in their account. You use that card to deposit. The transaction goes through. You see the money in your trading platform. You are excited. You place a trade. 2 days later, your account is locked. You receive an email demanding proof of ownership for the funding source. Why? Because of anti-money laundering (AML) laws. The name on the bank account must match the name on the brokerage account exactly, letter for letter. You cannot fund your personal account with your business account, even if you own the business. You cannot use your wife's credit card. To the AML software, this looks like layering, a technique used by criminals to hide the origin of funds. Now your money is stuck. The broker cannot send it back immediately, because that triggers another suspicious activity report. They have to hold it while their compliance team investigates you. This can take 30 to 60 days. For 2 months, your capital is in limbo. Always fund from a bank account that bears your specific legal name. There is a darker side to the funding trap. Structuring. Let's say you have $12,000 cash you want to deposit, but you know that banks report transactions over $10,000 to the IRS. So you decide to be clever. You deposit $5,000 today and $5,000 next week. Then you transfer it to the broker. Congratulations, you have just committed a federal crime called structuring. Brokerage algorithms are tuned to spot this pattern instantly. If you deposit just under the reporting limit multiple times, they will freeze your account and file a suspicious activity report (SAR) with the Treasury Department. You will never know they filed it. They are legally forbidden from telling you. They will just close your account and tell you to leave. Do not try to outsmart the banking system. If you have $12,000 to deposit $12,000. Let the report happen. It's a standard procedure. Trying to avoid it is what makes you look like a criminal. Finally, let's talk about verification latency. You submit your driver's license and utility bill. You wait and wait. Nothing happens. This usually happens because of the address mismatch error. The address you typed on the application form says 123 Main Street, Apartment 4. Your utility bill says 123 Main Street, Unit 4. To a human, these are the same. To a rigid verification bot, they are different. Apt does not equal unit. The bot flags it for manual review. Manual review means a human being in a back office has to look at it. These queues can be weeks long. To ensure instant verification, you must type your address exactly, character for character, as it appears on the document you are about to upload. If the bill uses an abbreviation, you use an abbreviation. If it spells it out, you spell it out. Mirror the document. So imagine this. You have navigated the application. You understood the risk capital definitions. You accurately reflected your knowledge base without lying. You fund it from a bank account in your own name, in a single lump sum to avoid structuring triggers. You mirrored your address syntax. You received the email. Welcome. Your account is active. You log in. You feel a rush of adrenaline. You see the chart flashing. You are ready to buy. Stop. Do not click that button. The default settings on every single one of these platforms, OANDA, IBKR, TasteIFX, are not set up for your benefit. They are set up for the broker's liability protection and standard conventions that are often terrible for execution. There is a hidden menu in your account settings that controls how your orders are treated, whether they are first in first out compliant, how slippage is handled, and whether your margin mode is set to isolate your risk or expose your entire balance. If you trade with the factory settings, you are driving a sports car with the parking brake on. You might place a stop loss that doesn't trigger because of a setting you didn't know existed. In the next video, we are going to do a live configuration. I am going to take you into the back end of these platforms and toggle the switches that the professionals change on day one. We are going to optimize your execution environment before you risk a single dollar. This is the technical setup that separates the tourists from the operators. Let's go to the settings menu. Welcome to the engine room. If you opened your account and immediately started trading with the default settings, you are currently operating with a blindfold on. The default configuration of almost every US broker is designed for the broker's safety and mass market appeal, not for your specific tactical advantage. In this section, we are going to surgically alter the DNA of your platform. We are going to flip the switches that turn a retail interface into a professional cockpit. Open your settings menu now. The first and most critical adjustment is one that 99% of beginners miss, and it ruins their technical analysis forever. It is the time zone and candle closure setting. Imagine this scenario. You are a price action trader. You rely on candlestick patterns. You are looking for a daily hammer candle, a pattern that suggests the market is about to reverse and go up. You see one on your chart. You buy. The market immediately crashes. Why? Because your broker's server time is set to GMT, Greenwich Mean Time, but the institutional market operates on New York close time, 5 p.m. Eastern Standard Time. Because of this time difference, your daily candle includes data from Sunday, creating a tiny, irrelevant Sunday candle that distorts your chart. It shifts the math of your moving averages and RSI. It literally changes the shape of the price data you are seeing compared to what a bank trader sees. You are analyzing a mirage. Step 1 for every platform Thinkorswim TradingView linked to OANDA or MetaTrader is to go into Settings, find Time Zone, and force it to New York or UTC-5, depending on daylight savings. You want your daily candles to close exactly when the New York banking session closes. This aligns your vision with the institutional vision. If you do not do this, you are trading against the flow of the river. Next, we must configure your fat finger defense. This is the setting for default order quantity. Let's look at a horror story from a trader we will call Sam. Sam uses interactive brokers. He usually trades 10,000 units, a mini lot. One day, he is rushing to catch a breakout. He opens the order ticket. The default setting on the platform was reset after an update to 100,000 units, a standard lot. Sam clicks buy without checking. The market moves 20 pips against him. Instead of losing $20, he loses $200. In a small account, that is a 10% drawdown in seconds purely due to a UI default. Go to your Order Defaults or Trading Preferences tab. You will see a field for default quantity. Change this number to the absolute minimum allowed by the broker, usually 1,000 units or 0.01 lots. Why? Because it is always safer to manually increase your size for a specific trade than to accidentally trade too big. Make the platform fight you to take risk. Do not let it hand you risk on a silver platter. Now we arrive at the slippage tolerance or price bound setting. This is your insurance policy against market volatility. When you click buy at a price of 1.1050, you assume you will get filled at 1.1050. But the Forex market is liquid and fast. In the 200 milliseconds it takes for your order to reach the server, the price might jump to 1.1055. If you use the default market order settings, the broker will fill you at 1.1055. You are instantly down 5 pips. This is called slippage. Platforms like OANDA and TasteIfs allow you to set a bounds or tolerance parameter. You can tell the system, I want to buy at 1.1050, but I will only accept a fill within 2 pips of this price. If the price moves more than 2 pips, cancel the order. This is crucial during news events like the CPI release or the non-farm payrolls. Without this setting, you could click buy and get filled 20 pips higher, putting you immediately in a massive loss. Go to your order ticket settings and look for maximum deviation or price bounds. Set it to a reasonable number for your strategy, typically 1 to 2 pips for major pairs. This forces the broker to respect your price or leave you out of the bad trade. The next configuration is specific to the US market, and it causes more confusion than any other topic: the FIFO display. As we discussed, US law mandates first in, first out. If you buy euro to US dollar at 10 a.m. and again at 11 a.m., you must sell the 10 a.m. position first. You cannot choose. However, how the platform shows this to you matters. On OANDA and Forex.com, the default view often aggregates your trades into one average price. If you bought at 1.1000 and 1.1100, it shows you one position at 1.1050. This can be dangerous because it hides the fact that your first position is actually in deep profit while your second one might be underwater. It blurs your tactical awareness. You need to find the setting for Portfolio View or Positions Display. Toggle this to Individual Trades or Expand Positions. You want to see every single entry as a distinct line item. You need to know exactly which tranche of your position is the oldest, so you can calculate your exit strategy according to FIFO rules. Do not let the software smooth out the reality of your exposure. Finally, we must address data subscriptions. This applies heavily to interactive brokers and thinkorswim. When you sign up, you often get delayed data by default for certain feeds. You might be looking at a chart that is 15 minutes behind reality. In Forex, 15 minutes is an eternity. A trend could start and finish in that time. You must verify your market data status. On interactive brokers, you need to log into the account management portal, not the trading platform itself, and navigate to User Settings, Market Data Subscriptions. Ensure you have subscribed to the IDLPRO or relevant Forex data packages. For spot Forex, this is often free or waived with minimum activity, but you must actively sign the agreements. If you see a little yellow D or delayed icon on your chart, stop immediately. You are trading ghosts. There is one final toggle that is a double-edged sword: one-click trading. Every platform will ask you if you want to enable this. It removes the Confirm Order pop-up window. When you click the chart, the trade executes instantly. For a beginner, keep this OFF. I repeat, keep it OFF. The milliseconds you save are not worth the accidental trades you will place when you drop your mouse or try to drag a chart. The confirmation window is your "Are you sure?" safety net. It forces you to look at the numbers one last time: the lot size, the stop loss, the take profit. It is a moment of mindfulness. Only when you are consistently profitable and your mechanical skill is flawless should you even consider removing this barrier. Your platform is now calibrated. Your time zone is aligned with New York. Your default size is set to minimum to prevent disasters. Your slippage bounds are protecting you from volatility. Your position display is showing you the granular truth of FIFO. Your data is real-time. You are sitting in the cockpit of a Formula One car. The engine is idling perfectly. The tires are warm. But there is one problem. You still don't know how to drive. Having the best platform and the perfect settings is meaningless if you do not understand the mechanics of execution. I am not talking about when to buy. I am talking about how to construct the order itself so that you never ever lose more money than you intended. Most beginners use market orders. They just want to get in. But the professionals use a specific triad of orders, limits, stops, and OCO, one cancels other, to create a robotic trap for the price. In the next video, we are going to do a live fire exercise. I am going to show you how to place the 3 specific order types that every professional uses. We will explain the set and forget structure that allows you to place a trade, walk away from your computer, and know with 100% mathematical certainty that your risk is managed. This is where we turn theory into cash flow. Let's execute. Welcome to the live fire exercise. We are now standing on the virtual trading floor. You have done the research, you have passed the background checks, and you have configured your engine. Now you must learn to drive. This section is the difference between a gambler and a professional operator. A gambler throws money at the market and hopes it sticks. An operator constructs a position architecture that is mathematically designed to survive. Most beginners think execution is just clicking a big green button that says, buy. That is not execution, that is suicide. When you click Market Buy, you are sending an unconditional surrender to the market. You are telling the broker, I don't care what price you give me, just get me in. In a calm market, this might cost you a pip or two. In a volatile market, during a news release or a liquidity crunch, a market order is a blank check. You might click buy at 1.0500 and get filled at 1.0520. You are instantly in the hole. To trade like a professional on platforms like Thinkorswim or Interactive Brokers, you must graduate to the limit order. Think of a limit order as a sniper lying in the grass. You are not chasing the target. You are picking a specific coordinate and waiting for the target to walk into your crosshairs. If the market price never reaches your specific level, the trade simply doesn't happen. And that is okay. One of the hardest lessons to learn is that missing a trade costs you $0. Chasing a bad entry costs you your capital. Let's walk through a concrete scenario to illustrate the holy trinity of order entry. The bracket order. This is the single most important mechanical skill you will learn. A bracket order consists of 3 distinct instructions bundled into one packet: your entry, your stop loss, and your take profit. Imagine you are analyzing the US dollar to Japanese yen pair. It is currently trading at 145.50. Your analysis suggests that if it pulls back to 145.20, it will bounce and go higher. Impatient Ivan, our amateur trader, sees the price dropping to 145.30 and panics. He thinks, it's getting close, I don't want to miss it. He hits market buy. He gets filled at 145.30. He then scrambles to figure out where his stop loss should be. While he is fumbling with the menus, the price spikes down to 145.00. He is frozen in fear. He has no protection. Sniper Sarah, our professional, uses a bracket order. She opens the order ticket on OANDA or Taystifx. She sets her entry order type to limit. She types in 145.20. She is telling the system, do not buy this unless the price is exactly 145.20 or better. But she does not stop there. Before she hits submit, she activates the risk controls section of the ticket. She sets a stop loss at 145.00. This is her ejection seat. She is predefining her pain. If the market drops to 145.00, the system will automatically sell her position to prevent further catastrophe. She calculates that the distance from 145.20 to 145.00 is 20 pips. Then, she sets her take profit at 145.80. This is 60 pips away from her entry. She is risking 20 pips to make 60 pips. This is a 1-to-3 risk-to-reward ratio. Here is the magic part. She hits submit. She can now close her laptop. She can go to the gym. She can go to sleep. Her instructions are sitting on the broker's server, not her computer. If the price hits 145.20, her buy order triggers. The moment, the exact millisecond, that buy order becomes an active trade, her stop loss and take profit orders are instantly armed. They are live in the market. If the price crashes to 145.00 while she is driving, the system protects her. If it rallies to 145.80, the system pays her. She has removed human emotion from the execution. She has turned a chaotic event into a structured business transaction. This leads us to a critical setting often found on these tickets: TIF or time in force. You will usually see options like day and GTC. Day means that if your limit order hasn't been triggered by the end of the trading session, usually 5 p.m. New York time, the broker deletes it. GTC means good till canceled. Stays there forever until you remove it. For a beginner, day orders can be a trap. Imagine you do your analysis at night. You set a limit order to buy euro to US dollar. You go to work. At 5 p.m., while you are commuting home, the order expires. At 7 p.m., the market hits your level and takes off like a rocket. You check your phone expecting to be rich, only to find you were never in the trade because your order expired. Unless you are specifically day trading the intraday session, default to GTC. Let the trade come to you on its own timeline. Now let's advance to a tool that leverages the power of the trend: the trailing stop. On platforms like MetaTrader 4 via Forex.com or the advanced ticket on Thinkorswim, you can automate the protection of your profits. Let's go back to Sarah. She bought US dollar to Japanese yen at 145.20. The price explodes upwards to 145.50. She is now 30 pips in profit. A novice trader watches this and sweats. Should I close it? What if it reverses? It's dropping a bit. They close the trade out of fear, banking a small win, only to watch the price run to 146.00 without them. Sarah uses a trailing stop. She right-clicks her position and selects Trailing Stop, 15 pips. This tells the server, follow the price up. Always keep my stop loss 15 pips behind the highest price reached. As the price moves from 145.50 to 145.60, her stop loss automatically moves from 145.35 to 145.45. It climbs the ladder. If the price suddenly reverses, she doesn't lose her initial risk. She actually gets stopped out in profit. The trailing stop allows you to ride a winning trend until the trend actually breaks. It answers the question, when do I exit? With a mathematical algorithm rather than a gut feeling. However, a warning on trailing stops. On some platforms, specifically older versions of MetaTrader, trailing stops are client-side. This means your computer must be on and connected to the internet for them to work. If your Wi-Fi dies, the trailing stops moving. On more modern cloud-based platforms like OANDA's Engine or Thinkorswim, they are usually server-side. You must verify this distinction in your platform's documentation. Do not assume the server is doing the work if the software requires your terminal to be open. Finally, we must discuss the partial close. This is a technique for psychological salary. You bought 10,000 units, one mini lot. The market moves in your favor. You are up $50. You want to let it run to your target of $150, but you are scared of losing that $50. On OANDA and Tastifx, you can modify a live position. You can open the ticket and select Close Partial. You can choose to sell 5,000 units, half your position. You bank $25 immediately. That cash is yours. It is realized. The remaining 5,000 units are still running. You can then move your stop loss on the remaining half to break even. Your entry price. Consider the position you are now in. You have $25 in your pocket. The worst-case scenario for the remaining trade is that it comes back to your entry, and you make $0 on the second half. You literally cannot lose money on this trade anymore. You have created a risk-free opportunity. This state, the state of risk-free, is where flow state happens. When you are no longer afraid of losing money, you see the market clearly. You don't panic at small red candles. You let the trade breathe. Learning to execute partial closes and move stops to break even is how you bridge the gap between a stress-filled hobby and a sustainable career. We have covered the selection of the broker. We have navigated the legal minefield of the application. We have optimized the back-end settings. We have mastered the mechanics of the limit, the bracket, and the trailing stop. You are technically ready. You have a Ferrari and you know how to shift gears. But we have ignored the most dangerous variable in this entire equation. It is not the Federal Reserve. It is not the high-frequency trading algorithms. It is not the broker fees. The most dangerous variable is the gray matter between your ears. You are about to face the first 30 days. This is the period where 90% of the people watching this video will quit. You are going to experience the dopamine rush of a win and the crushing physical pain of a loss. You are going to feel the urge to revenge trade to make back what you lost. You are going to deal with FOMO when you see a move you missed. No software setting can save you from these emotions. Only a battle plan can. In the final part of this masterclass, I am going to give you the 30-day survival protocol. This is a strict day-by-day roadmap of what you are allowed to trade, how big you are allowed to trade, and exactly what to do when not if you take your first losing streak. This is the psychology of survival. Click the next video. We finished this now. This is the 30-day survival protocol. This is the document that stands between you and financial annihilation. Most beginners treat their first month like a trip to Las Vegas. They deposit their money, they feel the rush of the lights and the charts, and they start betting on colors. By day 30, the casino has their money, and they are left with the story about how the market is rigged. We are going to invert that dynamic. For the next 30 days, you are not a trader. You are a risk manager in training. Your goal is not to make a single dollar of profit. Your goal is to execute 20 perfect trades and end the month with your principal capital intact. If you start with $1,000 and you end the month with $990, you are a massive success. You have survived the period where the vast majority of your peers perished. Phase 1. The mechanical handcuffs, days 1 through 10. During this phase, you are operating under martial law. You have zero autonomy regarding your position size, regardless of which platform you chose. Whether it is the flexibility of OANDA or the raw power of interactive brokers, you are strictly forbidden from risking more than 0.25% of your account on any single trade. If you have a $1,000 account, your maximum risk per trade is $2.50. This sounds insulting to many new traders. They calculate the potential profit on a $2.50 risk trade and realize it might only be $5. They think, I can't get rich making $5. You are missing the point. The purpose of Phase 1 is not income. It is desensitization. When you are new, pressing the buy button triggers a fight or flight response in your amygdala. Your heart rate spikes. Your palms sweat. You make irrational decisions because your brain perceives a threat to your survival. By trading with such insignificant amounts, you bypass the fear response. You are training your nervous system to view the act of trading as a boring administrative task, like filing a spreadsheet. Imagine a scenario where Trader Tom ignores this. He risks $50 on his first trade because he wants to feel it. He loses. He instantly feels a pang of pain and regret. He immediately places a second trade to win it back. He is now trading on tilt. He is reacting to pain, not price. By day 3, he has lost 20% of his account, and his confidence is shattered. Now imagine you lose $2.50. You feel nothing. You analyze what went wrong, you adjust your stop-loss placement on your thinkorswim chart, and you prepare for tomorrow. You are building a professional callus. Phase 2. The forensic audit, days 11 through 20. By now, you have placed roughly 5 to 10 trades. You likely have a mix of small wins and small losses. Now, we introduce the journaling mandate. Most people think a trading journal is a list of entry and exit prices. That is useless. Your broker's history tab already does that. Your journal must record your emotional state and your setup quality. Before you click buy on your Tastifx or Forex.com platform, you must rate your emotional state on a scale of 1 to 10. Are you a 1 Zen master or a 10 manic? If you are above a 5, you are not allowed to click the button. This simple rule saves more accounts than any technical indicator ever invented. Furthermore, you must classify your setup. Was it a trend follow? Was it a reversal? At the end of day 20, you are going to look at your data. You might discover a statistical anomaly. You might find that every time you tried to trade a reversal, catching a falling knife, you lost money, but every time you traded a trend follow, going with the flow, you made money. This is how you find your edge. You don't choose your strategy. Your data chooses it for you. You strip away what hurts you and double down on what works. Phase 3. The kill switch implementation, days 21 through 30. This is the most critical safety mechanism you will ever install. It is the fail-safe for your own psychology. It is called the 3-strike rule. The market is a random probability environment. It is mathematically possible, even with a good strategy, to lose 3 times in a row. This is normal variance. However, the human brain cannot handle 3 losses in a row gracefully. After the 3rd loss, your judgment is chemically impaired by cortisol. You enter a state of revenge trading. The kill switch rule is absolute. If you lose 3 trades in a single day, you are physically banned from your trading desk for 24 hours. You must close the OANDA app. You must shut down the interactive broker's workstation. You must leave the house. You are not allowed to look at a quote. Imagine if Trader Tom had this rule. On his bad day, he would have lost his 3 trades, perhaps down 3% for the day, and walked away. He would wake up the next morning refreshed, with 97% of his capital ready to work. Instead, without the rule, he kept trading until 3% became 30%. The kill switch stops a bad day from becoming a career-ending day. Preserves your capital for when your mind is clear. Now let's look at the graduation criteria. You reach day 30. You have survived. You have followed the sizing rules. You have journaled. You have respected the kill switch. What happens next? Do you immediately ramp up to full risk? No. You have simply earned the right to enter junior sizing. You move from 0.25% risk to 0.5% risk. You stay there for another 30 days. This is the concept of earned progress. The market does not care about your ambition. It only respects your discipline. You must prove month over month that you can handle the pressure before you add more weight to the bar. Let's discuss the compound vision to close this out. The reason beginners rush and blow up is that they do not understand the power of small numbers. They want 100% returns in a month. Consider this historical trajectory. If you can learn to make just 2% profit on your account per month, a target that is considered conservative and achievable for professional risk managers, and you are consistent, the math becomes staggering over a decade. You are not trying to hit a home run. You are trying to hit singles every single day for the rest of your life. We have spent 10 videos dissecting the infrastructure of the US Forex market. We have vetted the regulatory safety of OANDA, the institutional power of interactive brokers, the visual genius of Thinkorswim, the global connectivity of Forex.com, and the modern slickness of Tastifx. We have walked you through the legal traps of the application, the hidden dangers of the settings menu, and the mechanics of the bracket order. But ultimately, the platform is just a tool. It is a hammer. You can use a hammer to build a house, or you can use it to smash your own thumb. The difference is not the hammer. It is the carpenter. You now possess the shortlist of the best tools available in the United States. You have the knowledge to set them up correctly. You have the protocol to survive the learning curve. The industry of get-rich-quick educators wants you to believe there is a secret algorithm or a magic indicator that prints money. You now know the truth. The secret is low costs, regulated infrastructure, flawless execution mechanics, and rigid psychological discipline. The 90-90-90 rule is waiting for you. It expects you to fail. It expects you to be the liquidity that feeds the institutional sharks. But you have a choice. You can choose to be the anomaly. You can choose to be the 1 out of 10 who treats this as a business, who respects the risk, and who survives long enough to thrive. The charts are moving right now. The opportunity is there. But opportunity without preparation is just a hazard. You are now prepared. The deep dive is complete. The rest is up to you. Welcome to the market.